Welcome back to another episode of Built and Backed. Joining me today is Elizabeth McCluskey, a managing director at TruStage Ventures, the venture capital arm of TruStage. She leads the TruStage Ventures Discovery Fund, which invests in early stage fintech companies led by underrepresented founders. Over the last 4 years, she has deployed about $15 million to companies building solutions in lending, financial wellness, and banking technology. She's responsible for sourcing, diligence, and deal execution, as well as supporting a portfolio of 25 companies. She's an active community builder and thought leader in the fintech space, regularly appearing on panels, podcasts, and articles to share advice and commentary. Elizabeth, welcome to the show.
Thank you. I'm really excited to be here.
I'm excited to have you here. For our listeners, Elizabeth has a very impressive bio that will be posted in our show notes. But Elizabeth, that's where I'd love to start off is by having you share more about yourself and what you do.
Yeah, well, as you mentioned kindly in your introduction, I'm a venture investor, so I've been in the venture world for about 10 years. I initially started my career more in the finance space, so I did investment banking and wealth management before going to business school and transitioning into VC. But within venture, I've really wanted to focus on companies that make a difference and leaders who are kind of driven to build with purpose. So when I was at Impact Engine, I was investing in education, healthcare, economic empowerment, and environmental sustainability companies, primarily software, some maybe services element to them, and companies that were at the seed or Series A stage. And then for the last almost 5 years, I've been at TruStage, where, as you said, I'm leading the Discovery Fund, and my focus is on pre-seed and seed stage fintech companies that are building solutions for financial inclusion, particularly those who are trying to serve the needs of middle income consumers in the US. And all of those companies, as you noted, are led by underrepresented founders, which, if listeners aren't familiar, our definition is people of color, women, LGBTQ, and actually we just added veteran founders to that list. Each of those groups has received sort of a disproportionately low share of venture funding over time. And unfortunately, those numbers are just sort of stubbornly not budging.
Yeah.
So just as an example, women receive, on any given year, it's somewhere between like 1% and 3% of venture dollars. And so we believe, at TruStage, and I believe personally, we have to build companies to reflect the demographics of the US and like who the emerging consumers are, who the next generation consumers are. A lot of people talk about kind of the big wealth transfers that are going to take place over the next generation. And I think founders who come from the communities who are going to be most impacted are going to be the best positioned to build the solutions that speak to the populations they're trying to serve. So that's sort of, it's both an equity thesis for us, but also like a true investment thesis, because I think underrepresented founders are going to build some of the most compelling solutions in the fintech space. So that's
Yeah.
my venture world. And then I also do some angel investing as well. So I invest my personal capital into early stage companies, primarily women-led companies that are purpose-driven. And there I actually focus outside of fintech. So I'm looking at health and wellness companies, a lot of like parent and family tech, um, and some sustainability stuff.
Oh, amazing. And so your focus in fintech makes sense, of course, because of your career prior to joining VC. But I'm curious to hear what inspired you to focus on the health and wellness, fam tech, maybe even care tech verticals.
Yeah, I mean, I think the nice thing about angel investing is you can kind of do what you want and learn as you go and experiment. So it's sort of been an evolution of the areas that I'm interested in, but it really started with what I personally care about. So, after becoming a parent, it's like I joined the tribe of people who feel just totally overwhelmed and, have a lot of questions. And I feel like there's an emerging kind of category of solutions that are geared towards helping alleviate some of the, stress and burden of managing the logistics of a household with two full-time working parents, and like how do you navigate the early childhood years. So that's just something that's kind of personally been interesting to me. And I'm like, if I'm going to be a customer of these solutions, why not also be an investor in them and help founders with the expertise that I do bring to the table of connecting them to funds and thinking about how do they approach fundraising. On the health and wellness side, kind of same story. I think, as I am getting older and just sort of appreciating what a gift it is to have good health. Like, how do I personally maintain that? How do I make sure I'm giving my kids sort of the healthiest options and the best future? And then also, as a member of the sandwich generation of parents who are aging and seeing, the effects of some of that, just thinking about how do we think about the full continuum of health and wellness and longevity, and not necessarily just expanding our lifespan, but expanding our health span and helping everybody kind of, have those healthy habits, and the best tools to equip us all for health. So that's kind of on the health piece of things. And then sustainability, again, as a parent, thinking about, the planet that I want to pass on to my kids, and like what we're setting up the next generations for, and how quickly we have been sort of destroying certain things. Just trying to think about, what we can do again to make the sustainability kind of aspect more front and center for, both everyday living and then from an investment perspective.
Absolutely. And you worded it perfectly that with angel investing on your own time and with your own money, you do have more control or freedom over what you would like to invest in. But it sounds like with both what you do at TruStage Ventures and with your angel investing is that seems to be a crossover still of supporting underrepresented founders. Because I know you mentioned with angel investing, a lot of it is on women founders.
Definitely. I think I've been very fortunate to have come up in an industry where there hasn't been a lot of female representation, but I have actually always been fortunate to work with and for women. So my first role in finance, I had a female boss. And then when I was at Impact Engine, where I was kind of learning the venture trade, worked with, a female CEO and a female partner who kind of showed me the way. So
Mhm.
it's been an amazing experience because I have never personally felt underrepresented, or like I've been in a room where there haven't been other women at the table, but I know that that's a very uncommon experience. And so it's really important to me to help other people feel represented, both as check writers and as founders, because like I said, the statistics haven't moved a lot from the funding that goes to underrepresented founders perspective. The one thing I will say that is sort of a bright spot and like a potential signal for the future is that the percentage of female check writers at VC funds has been ticking up. So I think it's now
Oh, good.
somewhere around like 20%.
Mhm.
I'm not exactly sure, but somewhere in that neighborhood. And so, I think one of the theses is that as more women get into positions of being able to make the decision around which companies get funded, that will start to have kind of trickle down effects of getting more underrepresented founders funded.
Absolutely. And I'm curious from your perspective, um, what factors you see have led to more female check raters like coming about in that number increasing from there.
I think it's a couple of things, and this is not, not a scientific analysis, but I would say just sort of anecdotally. I mean, I think there was a wave of awareness and some pressure on some of the more established funds to start to promote and elevate from within, because women aren't necessarily underrepresented in the entry level or kind of like the associate positions. It's really just when you get to the partner level. So I
Mhm.
think there were some sort of conscious efforts made by firms to promote people and kind of help give pathways towards leadership. I think also there has been a big trend of what we talk about as like emerging managers, meaning people who are raising their first or second funds. And I think a lot of people have said, if I'm not going to become a partner at this fund, I'm going to go start my own fund. So I think a lot of the emerging managers you see, there's a much higher proportion of female representation within emerging managers than there are within some of the established funds.
Yeah, that makes sense. And I would love to hear from your perspective for anyone who's listening to this episode who may also be an underrepresented founder. What advice would you have for them for going through the process of being able to raise a round and get the capital they need for their startup?
Yeah, I would say, unless you're pitching to a fund that intentionally focuses on underrepresented founders, I don't think you necessarily need to lead with that. Like, I think in any case, whether it's the fund that I'm investing out of or any other fund, like when you're in venture, you're investing for returns and you're investing in great people and great ideas and big kind of opportunities. And so I think for underrepresented founders, the biggest thing they can do is just talk to other founders who have successfully raised, if there's investors who are willing to give them kind of time and feedback, getting a really crisp pitch, figuring out who is your target fund, whether it's like the check size you're looking for, the stage of company that you're at, the sector that you're working in, having a really good process put together around that targeted outreach. What does the intro say? Here's how you can create a forwardable to send to people when you're asking for intros. I think that's where underrepresented founders sometimes do have the disadvantage because they just haven't been in this ecosystem where like everybody they know is a founder or an investor. And so they don't know how to go about the process. And the biggest thing they can do is just learn kind of the rules essentially to
Mm-hmm.
be able to go through the process with more knowledge and more confidence that this is the way that they should be trying to fundraise.
Absolutely. And I also partially feel like there should be some type of responsibility of the represented founders to then give back and give back to and support the underrepresented founders, like almost become an ally and help them out with their connections and what they might be able to do to support them.
Yes, that would be fantastic. I do think, I mean, you bring up a good point because I do think a lot of the successful female founders want to pay it forward to other female founders, but it does sort of stay in this echo chamber. Like, I think it would
Yeah,
be great to continue to build and recruit more allies where it doesn't just have to be, women founders who are mentoring up and coming women founders. It can be men as well.
definitely. And I know that you oversee and support a portfolio of 25 companies, which is impressive. And so I'd love to hear some of the favorite portfolio companies you've supported, or even like really great achievements that you've been proud to watch them witness throughout this journey.
Well, no good VC will ever, play favorites. I love all of my portfolio companies equally. But yeah, just to give you a flavor. So, as you said, within the portfolio, we're looking at solutions around financial wellness, some lending, generally kind of trying to provide access to financial services at affordable costs for middle income consumers. One example of a company that I just checked in with, so I have some of their kind of stats top of mind, is a company called Hello Divorce. And it's an interesting one because you don't really want to encourage divorce. Like this company is not out there trying to nudge people into getting divorced, but it is a fact of life for a
Mhm.
huge swath of the American population. And it has been a fairly broken process for a long time. It's very costly, it's very time consuming, it's extremely stressful. And so the founder, Erin Levine, had been a family law attorney for many years, had helped people through this process. And she was like, how can I kind of add technology to my offerings to make my services and my process and sort of approach more accessible to the masses. And so she built a platform that initially was kind of like what they said the TurboTax for divorce, like software and kind of guiding people through the steps of if you're in this state and it's an uncontested divorce, like here's the paperwork you need to fill out, here's the deadlines, here's the next steps. And then people could engage with some advisors or even some counselors if they wanted to do arbitration or something like that. So that's where they started. Since then, they've really expanded to sort of serve the whole suite of needs related to people going through this process. So when you think about kind of some of the after effects, people often have shared real estate. And so how do they figure out how to manage who's going to live in the family home, or if they're going to sell it, are they going to refinance it, are they going to lease it back? So they're kind of partnering with some real estate related platforms and companies to help people get connected to those services. Um, Thinking about things like one of the reasons we were interested at TruStage is because we sell a lot of life insurance to middle income consumers. And so as people are rethinking like their family structure and the protection they need, what kind of life insurance policies do they need, who needs to be named on them, child custody arrangements, and thinking about things like that. So just there's so many things related to what happens when somebody goes through a divorce, a lot of financial related decisions. So that's one. And they I believe they've served about 15,000 consumers so
That's
far with the
amazing.
platform. And now they're also starting to sell into employers as an employee benefit. So, where you may be opting into like your health insurance and assorted other things, a lot of companies have some legal benefits that they're offering to employees now. And so Hello Divorce is going to be kind of part of that bundle of legal benefits where, again, it's not something that you ever anticipate happening, but if it does, your employer is going to give you coverage, and now you can sort of use Hello Divorce instead of having to go hire an attorney at, I think the average cost is something between like $17,000 to $20,000 for the average divorce process in the US. So that's one example. On the other side of the coin, there's long been a credit card industry that rewards consumers for spending, right? Like people love to rack up credit card points and try to figure out what are the best cards for whichever types of spending and redemption they want to do. And it really is part of this overall culture we've created around consumerism and sort of spending without thinking about consequences. So one of our portfolio companies is called Debbie, and they're trying to basically flip that on its head and reward and incentivize consumers for saving, for debt pay down, for like responsible financial behavior. And the way they do that is they partner with financial institutions like credit unions who are all used to paying several $100s to get new customers. So like I'm sure you've gotten postcards saying, open a Chase account and we'll give you $300, right? And that's their customer acquisition cost. But instead of just sending out postcards and giving people money if they open an account and keep it there for a few months, if people are on the Debbie platform and they demonstrate, a few months of great savings behaviors, or that they've been able to show, paying down their debt by 10 or 15% over a period of time, if they open an account with one of the affiliated financial institutions, their rewards for those behaviors get deposited into that account. So it helps their partner financial institutions get that new member to open an account and to keep that account. And they're incentivized to keep it open because the rewards are going to keep accruing to them there. So they have partnered with a good number of credit unions, and that's an ecosystem that we kind of are heavily involved in. So we've been able to help give them some spotlight there. And their users have shown some really sticky positive behaviors when it comes to actually improving their behavior. And the financial institutions have been able to attract and retain members at a lower cost. So it's kind of a win for everybody.
Oh, I love that. And it makes me wonder too, if you see any trends happening in fintech along these lines or see anything popping up. But I wonder if there's any fintech companies on your radar that might support more of like the younger generation, because there's so much talk about how it's so important for the younger generations to have financial literacy, and it's not something that's really taught in school. And we I guess inherit like our financial habits from our parents or from like our older generations. And so I'm curious if that's something that you've seen popping up with these startups, if they've been catering more towards that younger crowd.
Yeah, we've definitely seen a lot in this space, and it is also of particular interest to our credit union partners because the average age of a credit union member is about 53 or 54 years old. So they, along with everybody else in the financial institution world, needs to figure out what's going to appeal to younger consumers, but at the same time, how can we educate younger consumers about how to kind of navigate successfully their financial lives. So one of our portfolio companies that's doing just that is called Brydge. It's led by two female co-founders who are part of Gen Z themselves. So like they experienced these problems firsthand. Again, kind of going back to what I was talking about at the beginning, they lived this problem. They were both models who were earning income as teenagers and just didn't know what to do with it, like how to manage it, where to spend it, where to put it. They had a lot of questions, and there wasn't a lot of transparency around, especially their peer group, like what are other people doing? And so they built Brydge kind of on that philosophy of let's make a finance app that's a bit more social, because Gen Z is used to sharing everything else about their lives. Let's give them an outlet to do that related to their finances. And so people can kind of pose questions to the community, and then you can get community responses around like what's the appropriate amount of rent to be spending for a 24-year-old living in New York City, and that can be kind of geographically specified too. So if you're in New York, your finances are going to look a lot different than if you're in like Omaha, Nebraska. But they can
Right.
help people kind of crowdsource that data. And they bring in experts who offer really interesting insights and input into some of the financial decisions that are really facing Gen Z. So they just had a partnership and somebody come in who is on the fertility, like insurance and planning side of things. So as I think, fertility rates have come down and younger generations are starting to think about, should I freeze my eggs? Like, how do I prepare for the future? They're bringing the insights about those types of questions that Gen Z is asking to their audience. And they've been very successful at doing that. They have a huge base of consumers who are on the platform, and they've also been able to attract some brands and some companies who want to get in front of those Gen Z users. Mm-hmm. So that's on the Gen Z front. I think after Gen Z is Gen Alpha, right? So like the even younger ones. And we have another company, it's not in the Discovery Fund, but it's in the Ventures portfolio, which is our sister fund, called Goal Setter. And they're really about family banking and financial education for even the youngest kids. So helping parents set up their kids for success from a very young age with, savings accounts, like being able to distribute an allowance into certain types of accounts and helping kids understand that. And then they put lessons together with very relevant content. So one of the ones I remember is like they have a Beyonce video that they use to explain like the concept of earnings and savings and things like that. So trying to make things that are relevant to the generation they're trying to engage with. I mean, I think, and the CEO of that company and founder of that company came from a background as an executive at Nickelodeon. So she understands how to create engaging content and entertainment for kids. And then she was just kind of applying a financial lens to that. And I think that is really important because, again, you have to know the audience that you're serving, and different generations are going to be receptive to information in different ways. So that's really a key thing we look for when we're looking at companies that are serving specific audiences, is like, do they really know how to resonate with that audience?
Yeah. And like you've shared to me, especially with Brydge, having that lived experience translates so well and resonates so well with the users and audience that they're looking to serve.
Yeah.
Yeah. And one thing that you mentioned about, or kind of talked about briefly with both Brydge and Hello Divorce, is kind of like starting with what it sounds like. They started with a B2C focus and then later added on that B2B focus, which is really interesting. And so I'm curious to hear if you have any thoughts or trends that you've noticed around that, or even advice for fintech companies who are looking to do something similar. Like once they get the B2C part down, adding on that B2B part and having two audiences that they serve.
Yeah, it's a great question and insight. A lot of companies try to start with direct to consumer, and it turns out to be very, very difficult. And so they may end up pivoting to B2B. Both of the cases you just mentioned, I think, are kind of the right reason to go into B2B, which is like you've gained some traction with consumers and it's now compelling because you have this installed user base, you have some data. And so that is what makes you even more attractive to enterprise customers, because you can show like this was working with consumers, which are often some of the most difficult like go-to-market strategies to crack. Mm-hmm. And then you can tap into what are longer sales cycles, but are much bigger contracts, right? So when you sell one B2B customer, you can get hundreds of thousands, if not millions of dollars in one contract. Whereas when you're going direct to consumer, it can sometimes be like dollar by dollar that you're getting traction. But like I said, it's hard to start with B2B because it is such a long sales cycle. And so I like to see companies that are kind of doing experiments and willing to test the waters in both categories. So they might come in with a certain hypothesis, like we think this is going to be a really great B2B product, but we want to go out there and truly understand who our ultimate users are going to be. And so gathering that data, whether it's in betas or pilots or like focus groups, just to start to get some of those metrics around, like, here's how long they spend on the app each day, or here's, what the engagement rate is if we're sending emails out, things like that, that can help give them some talking points and some narrative that they can then go to fuel their B2B sales discussions with.
Yeah, that makes sense. It's just like really focusing on that research, understanding who you can serve, and then being able to add on that second leg when it makes sense.
Yeah. And I think another thing that I've seen is you can really tell a huge difference between the founders who are very scrappy and who are like, we're going to go out and find users however we can, even with no dollars. Like we're going to go into Reddit threads, and we're going to host community events, and we're going to, just get people organically to our platform versus people who have no traction and who are fundraising and they're like, we need $1 million to go acquire our first 1,000 customers. And it's like, no, you don't.
Yeah.
You need to go acquire your first 1,000 customers, and then you need to figure out who they are, why they resonate with you, and like either what's going to make the product better or how are you going to reach them faster. But you have to figure that out before you start spending money, because if you're just paying to acquire customers, you're not really getting to those deeper insights of what is it about your product that's resonating with them versus just, spending enough money on ads that someone will eventually click through.
Yeah, that's a really great point. It's like if you can find your first 1,000 users through grassroots marketing and sales efforts, like that proves the model, the business model that you have, and will show that there's so much opportunity and potential to scale from there once you have money behind
Yeah,
you to support you.
right. And it doesn't, at least in my opinion, it doesn't need to be that much traction. But I think there is kind of this debate going on right now between, and there's sort of like the polarized sides between the founders and the VCs, where I think founders have been frustrated because even pre-seed investors these days have been talking about how they want to see some traction. And, you hear this common refrain from founders that people are like, come back when you have more traction. And it's like, if you're a pre-seed fund, how can you expect traction? But I think it's just exactly to that point that it doesn't have to be hundreds of thousands of dollars, but you want to see that somebody isn't trying to just take a shortcut of like raising money to figure things out. You want to see that they've put in some time to figure things out and they're willing to do that, because it is going to be a long road and a hard road. And so, in my opinion, what those pre-seed funds are saying is, show me that you've got the goods. Like it doesn't have to be the fully baked business, but I want to see that your approach is that you hustle, that you're scrappy, that you make do with very little. And then we're going to put fuel on the fire once we've started the fire. But I need to see that you can start the fire.
Yeah, and I'm glad that you mentioned that because you bring up a good point that it's like they don't need to be at a certain level yet, but like you said, just kind of like show their passion and that there is like success and traction there. Because I wonder if sometimes founders like get discouraged where they think they need to have X amount of users or whatever before they can go to try to get some money. But really, like you shared, it's just they just need to have their heart in it and put in a lot of work and show that there is that potential for it to take off.
Yeah. Yeah. I mean, there's a company that I'm looking at making an angel investment in, and they have $0 of revenue, but they have an alpha. They had an alpha testing group and now they're into the beta testing group, and they just are showing amazing engagement rates. Like people are coming back to the app multiple times a day. Then they have a WhatsApp group where users are giving them feedback on the product, and the users are highly engaged in talking about what they would want to see, what they like, what they don't like. So it's like none of that is revenue, but it is data points and proof points to tell me that they're building this kind of with this community oriented attitude, and that they want to learn and gather as many insights as they can to be able to build the best product off the bat.
Hmm. Absolutely. And on the topic of angel investing, I've spoken to a lot of people recently who are really interested in getting into it. And so, since this is something you do, I would love to hear your advice that you would give to someone who is looking to make their first angel investment.
Yeah, I would say despite having been an investor for a long time, I'm actually relatively new to the angel investing world. I've been doing it for probably about 2 years. And it was intimidating even to me, even as a professional investor. And I think there's a lot of, misperceptions or stereotypes or things that might have been true historically that are no longer true today,
Hmm.
with the primary one being you don't need a huge check to be able to get into angel investing. I think historically, angel checks were written by very wealthy people who were putting tens of thousands or hundreds of $1,000s into individual companies. Whereas I think now, because of some of the groups that are out there and platforms that have facilitated kind of forming SPVs and things like that at scale, you can invest in companies for as little as $1,000. And it's not necessarily kind of the crowdfunding model, but it's just like if you join communities of angels where everybody's putting in a check of $1,000, you can end up putting in a $50,000 check into a company through an SPV, meaning there's a bunch of small checks, but they're going onto the cap table as one line. So
Mhm.
when I first started, my biggest goal was just understanding who was out there, what were the groups that were investing in things that resonated with me and with kind of that thesis that I wanted to pursue. So I've joined a few groups, I've left a few groups, I've joined a few other groups, and I have now found a few that I like where I see some deal flow that's relevant and that I consistently kind of want to lean into and do diligence on. So I would say for people who are thinking about getting into angel investing, definitely start by joining some groups. Like it's not something that you want to begin doing completely on your own, and you probably are not going to have the time or the capacity to do that. So, whether you care about like defense tech or female founders or CPG, whatever your interest area or your curiosity is, like go out and do a bit of research and have conversations with people to say, are there groups out there that are focusing on those areas? And I would join one or two of those, see what the deal flow is, see if they have educational events that you can learn from. I mean, I'm in a group where I did an angel kind of 101 for the members recently. So see if they have resources like that that can help you kind of get educated at the same time that you're starting to see deals. But I think ultimately,
Mhm.
don't invest too quickly. Like, don't invest in the first deal that you see. Start to, just give yourself time to understand what are the dynamics of companies that are out there and what do you gravitate towards, what do you have questions about, and don't be afraid to ask those questions, especially of your fellow angel investors, because it's a pretty like communal environment is what I've found. People are usually willing to share their insights and why they're really excited about a company or why they pass on a particular deal. And so just learning from others who have maybe started the process a little bit earlier from you, I think can be a really great resource.
Yeah, great advice, especially the part about joining groups. And along that line, you also mentioned like kind of alluded to that you might not stick with the group and that's okay. It's all about kind of
Yeah.
like finding the right fit, how you joined a few, left a few, found the ones that you felt the most like comfortable in. And I think that's an important reminder for people is like you don't have to stick with the first group that you join. It's important to find one that fits
Yeah.
your goals and the types of startups you're looking to invest in.
Yeah, you've got to shop around.
Hmm.
And I sort of made that as a goal for myself in my first year was like, I'm going to join a few groups and I'm going to see what I like. And then after a year, I reflected and I left a couple and I joined a few new ones. So, and I think these groups try to make it, everyone's trying to reduce the barriers, right? So, like, there may be annual fees to be a part of a certain group, but they're not, I mean, at least the groups I join are not exorbitantly expensive. There
Yeah.
may be some that are a lot more expensive, but it's enough that I was willing to say I'm going to try this for a year, and if it's
Mhm.
not a good fit for me, then I just won't sign up the next year.
Yeah, definitely. And then on the VC side, if there are any fintech founders who are listening to this episode who are looking to get funding, what advice did you have for them for that specifically?
I would say do not underestimate the power of building relationships like in advance. So if you're looking for funding now, this advice doesn't apply to you today, but it will apply to your next round. Get to know the funders and the VCs who you want to eventually invest in your company. Start to build those relationships now without the pressure, without saying, like, I'm looking for X dollars today. It's more like, I'm building in this space. I'd love to get on your radar. I'd love to tell you about what we're doing. I'd love to understand what milestones or what metrics you would want to see to be able to invest in the future. And then have an investor update list. Ask people if you can add them to that. Send out communications, at whatever cadence you feel comfortable with, whether that's monthly or quarterly, but just keeping yourself kind of top of inbox and top of mind for people cannot be underestimated, both just to see you in their inbox, but then also to see again how you think about things, how you approach things. Um, I posted something on my LinkedIn a couple months ago, which I'm happy to share as kind of like an after note that says the things that I want to see in monthly updates from founders, things like what were some wins that month or whatever that time period is, what were some of their learnings, what are some of the asks they have. I think you should always have asks top of mind, even if someone isn't your current investor. You never know how they could be helpful, if it's a customer intro, a fundraising intro, a hiring intro, whatever it may be. um, so I think just building that pattern of like transparency, communication is a huge part of, especially for early stage founders, because when companies are early stage, you don't have as many business metrics to rely on. It's really a lot about the person. And so helping yourself kind of establish yourself as a strong founder, as a strong leader, can go a long way towards making that decision easier when it is time to fundraise.
Yeah, I love that advice about building relationships. And to your point, the investors that founders are connecting with don't need to be their current investors, but just kind of nurturing them ultimately and warming them up and being able to take them on your journey of how you've grown and how your startup has scaled throughout time. Sounds like it might make it easier to close the deal when they are looking for some money because the investor has been kept in the loop throughout all that time and knows what's been happening and progressing.
Exactly. Yeah.
Yeah, that's great. And one question I have for you that I always love to ask our guests is I love to ask our guests to give a shout out to someone in tech who's doing something cool right now. So it could be a founder that you admire, or another VC, or even a community builder. I'm curious to hear who your shout out would be given to.
Um, this is a company that I just invested in as an angel recently, and but they're also very much in the startup ecosystem. So it's a company called Lexi AI, Lexsy AI, and the founder Christina. She's a former Cooley attorney, so she was an attorney that kind of lived and breathed helping early stage companies with, you know, getting their documents in order, like doing fundraising, going through rounds. And again, sort of similar to the Erin story with Hello Divorce, she was like, attorneys are outrageously expensive. How can we, bring the costs down, especially for startup companies where they don't want to fundraise just to spend all of their money on legal. And those are oftentimes check the box things, but you want to be protected and you want to kind of be in the right position. So she has built an AI enabled kind of legal services platform that has real attorneys supporting early stage companies, but also a lot of the stuff can be kind of auto populated and initially drafted to significantly reduce legal time. Um, I love this story because she's a female founder. Most of the angels on the cap table for this first round are women, which was sort of an unintentional thing. But I think a lot of people see her as inspirational and like want to support a company that's building in this space. And I suspect that she will have a lot of female founder early customers as well.
Oh, yeah, that's a great one. I love that. Elizabeth, this has been such a good episode, and I've so enjoyed having you on the show to talk about all things VC and angel investing. And I'd love to have you share with our listeners where they can find you online in case they'd like to connect.
Yeah, the biggest platform I use is LinkedIn. So you can find me there, and I comment and post relatively regularly. I don't always respond to my DMs there because I do get a lot, but if you do reach out to me there, I have kind of an auto reply that says some of my different email addresses depending on what you want to talk about. And then for the Discovery Fund, you can go to TruStage Ventures website and find our kind of generic contact information there.
Amazing. And I'll include those places in the show notes that our listeners can easily find you from there. But thank you so much again for coming on this week's episode of Built and Backed.
Thanks for having me.